Did Amazon even exist in 2008? I'm not even sure. It's amazing how fast.
I'm pretty confident they did.
They were probably just selling books.
Yes.
By the way, if you're
watching
have a
Prime account,
Amazon,
sure.
We're big fans of yours, and you can sponsor our show.
Welcome to the Old Fashioned Real Estate Show, where hosts Brian Leverage and Jeffrey Holst for our old fashioned real estate advice.
Welcome to the Old Fashioned Real Estate Show. My name is Jeffrey Holst, and this is
Brian Leverage.
And we're excited to be back.
Yes.
So we have an interesting topic to talk about today. We're talking about, both on a macro and micro level, markets. Mm-hmm. But not market cycles. We've done that show before. This is more like, how do you decide what's going on in a particular market? Is it an upward trending market? And by market, we mean like a neighborhood or a city, something like that.
Sure.
So, Brian, if you're in Chattanooga, right?
Well, do we want to talk about the macro first, maybe, and then dive maybe into the micro?
It sounds like you do, so I guess that's what we're going to do. All right. So on a macro level, how do you decide what city to invest in?
Well, I think primarily it's jobs, right? You want to look at the overall economic climate of a city or a region and you know, along with some historical data too, to see, you know, is this an area that's attracting employers? Because if it is, then you pretty much have a good predictor of future appreciation, rent growth, etc.
So job growth versus stagnation, and then also probably the breakdown of employers. If you're in a company town where the whole town is basically employed by one company, that's a little bit different than if you're in a place like Chattanooga, frankly, where there's a diverse workforce, hospitals, transportation.
I would argue you probably don't want to go move to a town where there's a single textile manufacturer supplying most of it.
Or a plastic manufacturer.
Although that's been the case for probably about 60 years at least now.
Oh, and you know, there are people that specialize in investing in places like college towns because they want to do student housing, or military towns because they think military bases are, you know, a good source of continued renters. And by the way, that's exactly true. Students show up unless there's a coronavirus. Military people show up unless the base, a war, or unless the base closed down, right? So if there's a war, that might keep the base open at least, and then it's okay. But
or all your soldiers on deployment.
But they usually have families and stuff. But the point is, if you pick something where you have one primary employer, one primary source of potential renters, you're taking additional risk. Now, it might be that you have a better return because that risk reward, return, it can make a difference. You can get more demand in a town with a military base, or a school. But again, something could happen. So you're saying look for wage and employment, diversity, and growth. What about population? Does that matter? Small town versus big town?
I mean, it does. I mean, to an extent. I think generally larger markets, you should expect to have higher entry points because there's more demand, for instance.
Depending on how much supply there is, right? Because it's still a demand and supply curve.
It's kind of a feast or famine, I think, in larger places like that.
Right. So if you're in Manhattan, prices are going to be really high. There's going to be a lot of people, so a lot of demand.
But when it goes sideways, it really goes sideways.
I think recently there's been a lot of articles showing that there are people actually moving out of New York City and into the suburbs and into other states. And I think that might have something to do with the coronavirus. People are able to work from home, and they're like, I don't want to pay to live in Manhattan.
Right. I don't blame them.
Yeah, and so I think the trick is to look at the trends with population. The size probably doesn't matter as much because higher prices with a similar return doesn't really matter. You buy less properties, but you get a higher
cost
return.
of living is important.
Yeah. So I look for growing population areas. If it has, and I don't want to see populations that are going up like crazy because that creates a lot of speculation in the market. I want to see steady and consistent population growth, which honestly, Brian decided to move to Chattanooga because he believed it was a good market to invest in.
That's right.
And so let's just quickly, and then we'll move to the micro stuff, but how did you make that decision? How did you come to the idea to choose Chattanooga as your market?
Well, so we actually at the time were looking at Nashville as well as Chattanooga. And Nashville was getting a lot more of the press back then. This was back in 2008. And
so 12 years ago now.
Yeah, so Volkswagen hadn't even formally announced that they were going to be building.
No, and neither had Amazon.
Right. And so you're looking at
Did Amazon even exist in 2008? I'm not even sure. It's amazing how fast.
I'm pretty confident they did.
They were probably just selling books.
Yes.
By the way, if you're
watching
have
a Prime account,
Amazon, we're big fans of yours, and you can sponsor our show.
So Nashville, real big market, and I think, speaking of Amazon, they just decided within the last year to relocate a lot of their logistics nationally into Nashville, as a matter of fact. But what we liked was that the cost of entry was a lot lower at the time, and that holds true today as it did then, to come into Chattanooga than it did in Nashville. And of course, Nashville has exploded. Chattanooga has done really well. I certainly don't regret the choice I made. But
and there's also you've eventually moved here. You started investing here before you moved here. You eventually moved here. And so you also have the benefit of living here as opposed to Nashville, which some people would look at that and say, well, I'd rather live in Nashville.
Yeah.
But there are a variety of reasons why. I think the cost of living being one of them, of course. Traffic, another one, that make Chattanooga more appealing. And also a really great place to invest. And if people want to look at investing in Chattanooga, they should certainly give us a call. We're happy to talk to them about that because that's kind of what we do. In case anyone wonders what we do. Now, listen, I also invest in some other markets. And that's another part of this, which is a little bit outside of the scope of the video, but just briefly, when you're thinking about investing in a market you don't live in, which is something that you did when you started investing here. You lived in Southern California and you were investing in Chattanooga. What do you think is important in deciding that? Because it's a lot easier to invest in Chattanooga if you live in Chattanooga. Same with, it's a lot easier to invest in Michigan like I do if you have really deep roots and connections there. I mean, I have a partner there. I grew up there. So I have some knowledge about that market. If you don't have that knowledge, how do you?
Well, I think you have to be able to confidently answer why you want to invest really in any market. And I mean, we could talk about Detroit or Chattanooga or really any place else, right? But I think you have to have, and there's not necessarily a right answer here. There's what you're comfortable with from a risk tolerance standpoint, cost of entry, and so forth. But you also have to have, whenever you're going to invest out of market, you have to have a great team in place, right? That starts with property managers because that's really hard to do from a great distance.
Well, it's probably impossible. I mean, I know people do, but it's essentially impossible.
No, some people can and do and are quite successful doing it on their own. But generally speaking, which is
so contractors, property managers, bankers,
attorneys,
closing title companies, things like that. So you need to build a team, realtors, or some way to find deals, whether it's wholesalers or whatever.
And those people are going to get changed out a little bit too, because they might, somebody who's a good fit in the beginning may change for any number of reasons later on.
And you're going to spend some money and you need to build this in. You're going to need to come to your market.
Yeah.
I don't think it's reasonable to buy something from Southern California and Chattanooga and never visit Chattanooga.
No, I agree. If you're not willing to spend thousands of dollars visiting that market, at least initially, and then I would even argue that once you've started acquiring properties, you should spend time in that market on an ongoing basis. You've got to check in
once in a while. Listen, prior to coronavirus, I was going to Michigan at least 10 times a year. I've still gone twice since March, in spite of the fact that it's difficult to travel right now. And I have a really good team on the ground. I have a partner that runs everything, and I still feel the need to occasionally put my own eyes on my own property. It's something you have to do. Anyway, maybe sometime we'll have a discussion about out-of-state investing, but let's talk about the micro level. So now you've decided you want to invest in Chattanooga or Southern California. I can't imagine people decide that, but I guess some people do. So you've decided where you want to invest for whatever reason, and now you're going to have to narrow it down beyond the Chattanooga. Like you want to decide if you want to invest in one part of Chattanooga versus the other, or a suburb versus the city or the county. How do you make that decision?
Well, there's a lot of different factors. And again, my opinion is you really make your money when you sell. And you want to invest for cash flow. Don't ever get into things.
Can we stop there for 1 second? Most people say you make your money when you buy. You're saying you make your money when you sell.
Well, I agree with that to an extent. But if you're comparing the cash flow versus the equity appreciation when you sell, given, say, like a 5-year hold time or something like that.
Well, and also the amortization gains. And we did a whole episode on that, the 4 sources of real estate returns, which people can check out there. And for the people that are listening to us on podcast, now that we're a podcast, we're podcast official people. You can't see that I'm pointing up at the episode. You're just going to have to search the podcast app to find that episode.
So you want to get into markets where you have you're certainly poised for cash flow right out of the gate, because that's the important thing, right? You want the property to carry. But you also, in a perfect world, and this isn't always the most ideal or possible, just depending, is generally the biggest gains are made in transitional areas.
All right, so just to make sure I understand what you're saying, you're talking about emerging neighborhoods. So it might be kind of run down and depleted, but now new money's coming into that market. They're renovating the properties. It's just becoming trendy. It's not trendy yet, right? For people that are local in Chattanooga, it's not North Shore.
It might be, say, the East Main corridor.
Right. It's somewhere that's just outside of downtown. It's growing. Now, it's going to be different in every market, so the specifics don't really matter. The principle matters. There's in one of the courses that I was taking a few years ago, they talked about the danger of trying to go into a market too soon. So there is risk there, right? The first people into a market might guess wrong, and that market might not turn around. On the other hand, if you can find a market where maybe 20 or 25% of the houses have already been renovated, or 20 or 25% of the buildings have already been renovated, it's a pretty good likelihood that there's still upside in the market, but that's also that market's going to turn. It's not going to go negative. Right. If there's new construction in the area, like I said, 10, 15, 20% of the properties are new construction, then there's a good chance that the property values are going to continue to rise in that market.
If you're driving through neighborhoods and you see a decent amount of roll-off dumpsters, the big 30-yard containers, that's a great indicator that that's an actively improving neighborhood.
But if you drive through a market and it's 90% renovated, all of that growth is probably already priced in. Yes. So the trick is to find something where there's a lot of action taking place, but it hasn't passed 50, 60, 70% of the properties have already been renovated.
Which some investors call that moving the line, right? And the line could essentially represent like one side, like we mentioned, the East Main corridor, right? So you've got Main Street that runs east-west through Chattanooga, and stuff that is on the north side of Maine is in Highland Park, which is an area that I think we both agree has gentrified a lot already in the
growing
last
like
few
crazy,
years.
And now it's expensive to buy
The south side of Maine, on the other hand, within a few blocks of there, the prices are nowhere near the Highland Park side of Main Street, right?
Right, but what can happen, and may very well happen in that market, and we're not making market-specific predictions here, is that it might become like Highland Park. In some point.
Well, as people get sort of priced out of those little sub-markets, they tend to flock to the next best thing in their minds, right?
Right, and listen, there are lots of different ways to determine where the growth is going, and you probably can't, unless you're ready to spend an enormous amount of money, actually change the direction of growth. But if you see 2 markets that are growing, and there's a neighborhood in between them, it's a pretty good argument to buy the neighborhood in between. And Brian and I were just looking at a building the other day that we looked at. At one side of down the couple blocks one way, there was some new buildings, and a couple blocks the other way, there were some new buildings.
Yeah.
Nothing in between.
Right.
Now, that doesn't mean that it's ever going to grow up in between there, but it's potentially possible.
Yeah, it could prove to be a tragic mistake if we actually did buy it.
Well, I mean, we have no idea. In fairness,
we don't think so.
In fairness, we think that it's going to be a good property. But that's something that we're still evaluating, and we may buy, we may not. We don't know. Yeah. But the point is, if you see 2 markets growing together, and you can get in the middle of that. That's going to be really good. If you see markets, suburbs that are growing, I think a lot about where I grew up. There was, I grew up in Grand Rapids, Michigan, and outside of Grand Rapids, there's a number of suburbs, and outside of that, there was like country, like farmland, and every year it seemed like the properties creeped a little bit further out and the suburbs got a little bit bigger. Mm-hmm. And if you can buy a few miles out of a growing area like that, it's almost inevitable that you're going to be in that path of progress. Now, the thing about this is it's not a magic trick. You might be wrong, but also you're not the only one that knows this, and you have to be careful not to overpay just because something's in the path of progress. So it's really important to do your due diligence, to spend the time figuring out what the best investment is, and not worry too much about getting it exactly right.
I agree.
So, anything else that you want to add?
I think we covered it.
It sounds good to me. With that, thanks for checking out the show, and as always, be sure to subscribe and like this video.